Hello students and welcome to this example, which is question 4.2. It's a bit similar to question 4.1 but also slightly different. So let's look at the information given. In question 4.2 it says on 1 January 2004 ABC Limited orders stock to the value of $100,000 and the contract is non-cancelable. So we already know that this is a firm commitment, which makes it a fair value hedge. On the same day, they enter into a 3-month contract for an FEC worth $100,000. The stock is shipped on 1 January 2004 and arrives at the South African harbour on 31st January 2004. Goods are shipped by cost, insurance and freight. So this is quite important. If it's free on board, the transaction date would have been 1 January. If it is now, as stated here, cost, insurance and freight, then the transaction date is the date on which the goods arrive at the South African harbour. So transaction date will be the 31st of January 2004. Right, very important. Then year end is 28 February and then the payment date 31st of March. They've given us spot rates and forward rates. We just move it properly. So for the spot rates, they've given us rates on 1 January, 31st of January, 28 February, 31st of March. So now they're checking to see if you know which one should be, if you can read properly and see which one should actually be your transaction date. And then the forward rates. Of course, the spot rate is used to value the creditor. The forward rate is used to value the FEC. So that's the movements that they will cover as basically insurance for currency risk, quote unquote. So please remember, for the spot rate, there is an inverse relationship. So if the spot rate goes up, it is a loss. If the spot rate goes down, it is a gain. For the forward rate, it is used to measure gains and losses for the fair value hedge and the FEC. And if it goes up, it is a gain. If it goes down, it is a loss. So there's a direct relationship. Very important. So then they ask you to journalize entries as at the transaction date, the year end, and the payment date. So let's explore. What I know is that this is a firm commitment. So on transaction date, I will only need to account for one thing, which is the creditor and the goods that I am buying. And I need to recognize the creditor at the spot rate on the transaction date. Going to my memo, I'm then going to say the transaction date is the 31st of January. And I'm buying inventory. So I'm going to debit the inventory. I'm going to credit the creditor. And I need to recognize it at the spot rate. And the spot rate on the transaction date was R7.30 times $100,000, I believe. And that gives us R730,000. Right, so that is the entry that needs to be done if it is a firm commitment fair value hedge. Then we have our year end, which is 28 February. So what will happen on 28 February is we need to go and seek gains and losses in terms of the spot rate and the forward rate. For the spot rate, it's going to be a loss or a gain as it relates or it pertains to the creditor. For the forward rate, it's going to be a loss or a gain as it pertains to your forward exchange contract asset. So on 28 February, if I check the spot rate to value the creditor, I see that it has gone down. So it used to be R7.30, I beg your pardon, and now it's R7.25. So it went down. So this is a gain on foreign exchange. So I'm going to recognize the gain against the creditor. I'm going to say the creditor, and this is a gain on foreign exchange. Oh, look at that, poor spelling. And this is an item of profit and loss. So I'm just going to indicate it. Right, if I now look at the change in value, it went from R7.30 to R7.25. And I'm just typing it in the other way around so that I don't have a negative on my Excel. I'm going to times it by 100,000. It gives us 5,000 Rand. We also need on year end to go and value the FEC. So what are the changes in FEC? Well, on transaction date, it was 7 Rand 25, and it's actually the other way around. And now it's 7 Rand and 30 cents. So the forward rate went up, so it is a gain. It is in the same, it moves in the same direction. So I'm going to say gain on FEC, and this is going to be profit and loss because this is a fair value hedge. It's a firm commitment, and I need to put it against my FEC asset. And the change there will be 5,000 Rand as well. So here I once again just did the exact same calculation. 7 Rand 30 minus 7 Rand 25. All right, that was our calculation in terms of year end. So then we have on payment date. So payment date is on the 31st of March. And here I need to again recognize my gains and losses with regards to the creditor and the FEC asset. So going back, I can see that it's now 7 Rand for the spot rate. It's now 7 Rand 35. It was 7 Rand 25. So the spot rate went up, which makes this a loss. So I'm going to recognize loss on foreign exchange. And I need to put it against my creditor. The movement is 7 Rand 35 and 7 Rand 25 at $100,000. Right, that gives us a 10,000 Rand loss. I also need to go and explore what happened to my forward rate. So it's important to remember that on the payment date, the forward rate and the spot rate will be the same value because the insurer, for example, let's say you took out the FEC with the bank, they will only be willing to pay out or to cover you per the forward contract the value of what the creditor is requiring you to pay, and they are requiring to pay 7 Rand 35. So I'm just filling it out so they can put not applicable because they want to test whether you understand how the basically the insurance works based on the FEC. Do you realize that they will only be willing to then cover what the creditor is asking you to pay? So this went up, so this is a gain. So I'm going to say gain on FEC, and the double entry is the FEC asset, and there I'm going to have a difference. It is 7 Rand 35 minus 7 Rand 30, I believe, and times $100,000. Right, so I'm just calculating the difference there. Just want to double check that the figures are correct. Yeah. Right, and that's a total of 5,000. So now I need to close off and pay the creditor. So I'm going to make an entry for the creditor. I need to close my FEC asset because when the transaction is done, the FEC asset will no longer exist. And then out of my bank account, I need to pay the foreign creditor. So the foreign creditor is then charging me 7 Rand 35, the spot rate, times $100,000 on the day that I need to make payment. Then I need to go and look at what happened with the FEC because that account needs to be closed. So for FEC, I had 1,000 Rand in that account, And then for FEC, I had another 5,000 Rand in that account. So a total of 10,000 that needs to be closed. So I had a debit total of 10,000 Rand. So to close off the account, it's going to be a credit entry of 10,000. And the bank will then be my balancing figure of 7,725, and that is then the forward rate on the transaction date, the 7.25, if you want to cross-check yourself. All right, so those were the entries for a firm commitment fair value hedge in question 4.2. As you can see, the method in which you ship the goods will make a big difference in your transaction date, and then you need to have proper entries per the transaction date as it pertains to the way that the goods were shipped. I hope that you have enjoyed this video, and I will then see you in the video for question 4.3, which relates to a cash flow hedge.